Hi everyone. I'll be discussing the conceptual framework of the responsible trading system. This is a recorded version of the materials presented during the Bookaka Traders Summit held last October 1st at the TIU Theater. This will give us a solid foundation for understanding the system and provide a takeoff point for future videos that I'll be sharing when we apply it to actual trading situations in the Philippine stock market. Some notes on this presentation. This is responsible trading, so you take full responsibility for learning the materials presented. You may sleep during the presentation, but do not snore. You might wake up the person seated beside you. All figures and illustrations, when taken directly from my book, retain the same reference numbers, figures, charts, and so on. This is to ensure that people who have the book will be able to follow them easily when I post this presentation in my YouTube channel. A typical scenario. Based on my experience with trading forums and trading groups, I usually encounter the following scenarios. A new trader who's just starting out would usually ask two questions. The first is, ano pong stock ang magandang bilhin ngayon? What is the best stock to buy now? Many well-meaning people would readily give answers based on their personal experiences, preferences, time frames, etc. The new trader then, by elimination, usually picks the stock that has been recommended most, thinking that since it is the choice of the majority, it is also the best for him. Based on these inputs, he buys the stock, and if he's lucky enough, the stock goes up a few days later. This being so, the new trader starts thinking that stock trading is easy. It is good if this is always the case. Sometimes the opposite happens, which leads the newbie to ask the next question. Anyari? What happened? The newbie, being clueless about the stock he bought, is now very much worried, wondering why the stock price suddenly went down, and is now at a loss what to do next. I know many of you are smiling at this point and could easily relate to these scenarios. Very few people realize, but these are the two most dangerous questions that a newbie trader can ask. Why? Because these two questions make the newbie trader prone to becoming a VOH, a victim of hype. These scenarios get repeated every year. You always see the same questions being asked. The only difference is we see new faces. It is under the scenarios that responsible trading came into being. Something had to be done, and it had to be done fast to help people avoid becoming victims again. Responsible trading was developed by my more than 30 years experience managing company funds in different capacities as financial controller, finance director, and vice president finance of both local and multinational firms, and by more than 5 years experience actively investing and trading in the Philippine stock market. Responsible trading has 4 elements: self-discipline, continuous education, protection of capital, and full responsibility. Let us discuss them one by one. Let us go over these 4 elements one by one. practicing self-discipline. Self-discipline has been defined in several ways, such as perseverance, restraint, endurance, thinking before acting, finishing what you're doing, and the ability to carry out one's decisions and plans in spite of inconvenience, hardships, or obstacles. Self-discipline also means self-control, the ability to avoid unhealthy excess of anything that could lead to negative consequences. It also refers to the ability to forego instant gratification and pleasure in favor of some greater gain or more satisfying results. When applied to trading, this means telling yourself to sit down to prepare a trading plan before entering a trade, instead of watching your favorite TV show or doing your favorite activity. It also means implementing a trading plan. Entering a trade without a trading plan is one of the causes of miseries of a lot of traders. Continuously educating yourself. Learning, for me, is a continuous process, especially now with the exponential expansion of knowledge due to constant improvements in cutting-edge technology. I feel that learning is like going upstream in raging waters. If you do not keep abreast with current developments, you are going to fall downstream and left behind. In my case, this requires a lot of reading, watching relevant videos, applying what I learned, learning from my mistakes, and repeating the whole process. I also like conducting seminars when I have the time because this leads to mastery of the subject matter. In a similar manner, I also like to attend seminars conducted by others so I can learn from them. Protecting your capital at all times. Actually, in my opinion, the first lesson to be learned in trading should be money management before you even start to learn fundamental or technical analysis. In my case, money management came last, and it was only after a year of trading that I took my first loss, even after my speculative portfolio had almost been burned to the ground. Whether you realize it or not, trading is business, and your tool for conducting your business is your trading capital. Imagine a carpenter working without a saw or a hammer. How is he going to cut the wood? How is he going to drive the nail? No matter how good you have become, if you no longer have your trading capital, everything becomes useless. Taking full responsibility for your trading results. You and you alone should be responsible for your trading results. No excuses. You cannot blame anybody for your trading losses. The problem with getting a tip is that you tend to shift the burden of responsibility to the person from whom you took the tip, whether it is just a post from a forum or a personal advice. This is similar to an upward delegation. In the corporate world, you can delegate authority to your subordinate to make a decision, but you still have full accountability and responsibility for whatever results achieved. In the same manner, even if you have delegated the act of making a decision on what stock to trade, the tip you got either from a post or personal advice, you still cannot avoid taking full responsibility for the result of your trade. From being an advocacy, it was but natural for responsible trading to evolve into a system. As a result of the need to provide a structure for sharing knowledge, responsible trading developed into a complete system consisting of trading strategies, trading styles, methods, trading plans, and trading rules. The system is holistic and integrated and does not discriminate among other existing systems. It adopts and incorporates whatever best practices there are in trading as long as it adds to a person's trading edge. The Philippine stock market is a jungle that is both a goldmine full of opportunities and a landmine laden with traps. Only those who have prepared themselves well for the journey will be able to navigate this jungle and survive. Along this line, responsible trading aims to equip the new trader with the responsible trader's trading armor, the helmet of technical analysis, the breastplate of fundamental analysis, the shield of mental toughness, the sword of money management, and the shoes of being street smart. Let us go over these one by one. The helmet of technical analysis. This enables you to understand trend lines, support, and resistance. It gives you the knowledge when to enter and exit a trade. I have devoted almost half of my book to this topic. Next, the breastplate of fundamental analysis enables you to discern and distinguish which companies are worth trading and prevents you from buying companies that are empty and just full of hot air. In responsible trading, as much as possible, we screen by fundamentals and enter on technicals. The reason for this is we want to trade or invest only in companies that would provide good value for our time and effort. The only exception is when we decide to trade speculative stocks and stocks we do not intend to hold for more than 1 week. For these cases, technical analysis similar to the stock charts and analysis we share in our website would be suitable for the purpose. The shield of mental toughness prepares you psychologically for the mental tasks required in trading and helps you understand yourself and the emotions of other traders, resulting in price action and price movements. Trading psychology is about knowing ourselves as a trader, our emotions, the driving force that motivates us, and knowing others in the same context as well. The market is driven by many factors: economic, social, political, fundamental, technical, and these are eventually translated into two major emotions, which cause us to make buy, hold, or sell decisions. These are greed and fear. The sword of money management helps you to manage your trade and cut your losses and cut cleanly. In responsible trading, sitting on losing stocks is a double whammy. It drains your mental energy and ties up your trading capital, which you could otherwise use for better trading opportunities. The shoes of being street smart keeps you on your toes and enables you to put your trading knowledge to practical use and become aware of realities that are actually happening in the Philippine stock market. The responsible trader is not only knowledgeable in theories, but is also street smart. We are aware of current developments and all knowledge required to trade effectively, but we are also cognizant of the existence of dubious concepts and schemes that could derail our plans. This way, we're able to protect ourselves and others from being victims and do our part in raising the bar of trading to a more professional level. Responsible trading is evidence-based trading. David Aronson, in his book Evidence-Based Technical Analysis, published in 2006, proposed that technical analysis should be approached in a scientific manner. He rejects all subjective methods of technical analysis that are untestable. Evidence-based technical analysis relies on computerized methods for identifying patterns and combining evidence into useful trading signals. Our use of the AMI broker charting software, as well as software provided by an online broker, meets the requirement of evidence-based technical analysis. One area where we do not agree with David Aronson is his idea about chart patterns and Elliott waves as being subjective. Since these concepts are widely accepted by most technical analysts, we are also accepting this as part of the responsible trading system. Thus, in addition to chart patterns and Elliott waves, we have incorporated moving averages, volume, and other indicators, and apply critical thinking to identify low-risk, high-probability trades. We also incorporated some of the principles of evidence-based technical analysis and responsible trading and called it evidence-based trading. David Aronson did not specifically use the words positive and negative in his evidence-based technical analysis. We started to use these terms for the purpose of presenting our findings and observations in such a way that they would never be construed as a hype or a bash. Along this line, we have adopted and developed two main methods of technical analysis, which clearly stand out in a manner that is different and unique in their own way, and clearly identifies one who uses them as a responsible trader. In responsible trading, we have two main methods of technical analysis: the TRT map, or the moving average crossovers, and the TRT IAF, the Ichi Moku analytical framework. I'll discuss these methods one by one. The TRT map, the moving average crossovers. In responsible trading, we use the moving averages to identify trade setups and generate buy and sell signals. We use the 8 EMA, an exponential moving average, to determine very short-term trends and catch them faster than the simple moving average. We use the 15 EMA, another exponential moving average, to determine short-term trends and catch them faster than the simple moving average. We use the 8 EMA and 15 EMA crossover method to generate trade setups and buy and sell signals for scalping and day trading. A golden cross, 8 EMA crossing above the 15 EMA, is taken as a buy signal, and a dead cross, 8 EMA crossing below the 15 EMA, is taken as a sell signal. We use the 20 SMA, a simple moving average, to determine short-term trends. This is also called the swing trader's line. We use the 15 EMA and 20 SMA crossover method to generate trade setups and buy and sell signals for swing trading. A golden cross, 15 EMA crossing above the 20 SMA, is taken as a buy signal, and a dead cross, 15 EMA crossing below the 20 SMA, is taken as a sell signal. We use the 50 SMA to determine medium-term trends. This is also called the position trader's line. We use the 20 SMA and 50 SMA crossover method to generate trade setups and buy and sell signals for position trading. A golden cross 20 SMA crossing above the 50 SMA is taken as a buy signal, and a death cross 20 SMA crossing below the 50 SMA is taken as a sell signal. We use the 200 SMA to determine long-term trends. We use the 50 SMA and 200 SMA crossover method to generate trade setups and buy and sell signals for investments. A golden cross of 50 SMA crossing above the 200 SMA is taken as a buy signal, and a dead cross 50 SMA crossing below the 200 SMA is taken as a sell signal. We also use the 200 SMA as the bull or bear line. If price action remains above the 200 SMA, we consider the stock still in bull territory. If price action has fallen below, then we consider that the stock is in bear territory. In responsible trading, we usually avoid taking positions in stocks whose price actions have been below the 200 SMA for a long time. The only exception is if we see reversal signals like reversal chart patterns and bullish divergences. The next method is the TRT IAF, the Moku Analytical Framework. This is a point-based method to make reading Ichimoku charts as easy as ABC. Let me try to translate the Japanese terms into English for a better understanding. H means 1. Do you still remember the movies or TV shows where you have seen Japanese soldiers marching or exercising, and the commanders shouting repeatedly, Ich ni san si? So ich means 1. Moku means view or glance. Kinko means equilibrium or balance. Hyo means chart. Translated in English, Ichimoku Kinko Hyo means one glance balance chart or one glance cloud chart. The above term is self-explanatory because once you understand this method, it will enable you to understand the exact state of the market at a glance by just looking at only one chart. The Ichimoku chart consists of candlesticks and 5 lines. These are the Kijun-sen, or the baseline or standard line, the Tenkan-sen, also called the conversion line or the turning line, the Senko span A or the leading span A, the Senko span B or leading span B, and the Chikou span. The Kijun-sen, the baseline or the standard line, is usually shown as a red line on the chart. It is a calculation of the highest high plus lowest low divided by 2 over 26 periods. In Japan, where the method originated, since they work from Monday to Saturday 6 days a week, the average number of working days is 26. This explains why they use 26 as the standard moving average in the computation. The Kijun-sen is similar to the signal line in the MACD, the moving average convergence divergence, which also uses 26 days in the computation. The Tenkan-sen, conversion line or turning line, is usually shown on the chart as a blue line. The same calculation as the Kijun-sen or the baseline, highest high plus lowest low divided by 2, but over 9 periods, and it's plotted on a chart like a moving average. By trial and error and through backtesting, it was determined that 9 periods work best under this setup. You may recall that the MACD, the moving average convergence divergence, also used the 9 and 26 period combination. Similar to the MACD, buy and sell signals are generated when these two lines crossed over. A buy signal is generated when the Tenkan Sen makes a golden cross or crosses above the Kijun Sen. A sell signal is generated when the Tenkan Sen makes a death cross or crosses below the Kijun Sen. For easy recall, just remember that the Tenkan Sen or the turning line is the one that gives the buy or sell signal. The turning line is responsible for turning the fortunes in your favor. The two lines also serve as variable support and resistance. In an uptrend, the Tenkan Sen usually serves as first line of support, limiting the pullback. The Kijun Sen serves as the second line of support, which is very critical. If the pullback breaks down below the Kijun Sen, then it is considered a potential sign of a reversal in trend. In a downtrend, the reverse holds true. This time the two lines serves as resistance. The Tenkan Sen serves as the first line of resistance, and the Kijun Sen serves as a second line of resistance, which is very critical. If the price breaks through the Kijun Sen, then it is considered a potential sign of a reversal in a trend. The next two lines, the Senko span A and the Senko span B, are the ones used to form the Kumu or the cloud. The Senko span A or leading span A serves as the first line of the cloud. It is calculated by adding the Tenkan Sen, the 90 average, and the Kijun Sen, the 2060 average, and dividing by 2. The result arrived at is plotted with the line 26 days ahead of the last completed days of trading. The Senko span B or the leading span B serves as the second line of the cloud. It is calculated by finding the highest price of the last 52 days, adding it to the lowest price of the last 52 days, and dividing by 2. This is also plotted 26 days ahead. The space created between these two lines, the Senko span A and Senko span B, is called the Kumu or the cloud. The cloud also serves as indicators whether the trend is bullish or bearish. If the cloud is green, the trend is bullish. If red or sometimes orange, the trend is bearish. If the candles are inside the cloud, the trend is sideways or neutral. The fifth line is the Chico span, lagging span or delayed line. It is the closing price 26 periods behind the last daily close of the current period. I promised to make the technique as easy as reading ABC. I had done this by putting everything into an analytical framework, as you can see in Table 9. This is a worksheet where you can place scores to determine whether the stock under consideration conforms to the criteria of being a low-risk, high-probability trade setup. Based on your observation, just fill up the columns in the actual score column using the analysis and maximum scores as your guide. Ratings of 100% to 80% are considered low-risk, high-probability trades. Ratings below 80% could still be considered as such, as long as components 1, 2, and 3 are present. Responsible trading is continuously evolving, and we are always on the lookout for best trading practices to be incorporated into our system. In addition to being evidence-based trading, responsible trading has adapted trading strategies from the complete trading course of Cory Rosenblum as part of its system. These are mean reversion and mean departure as indicated in Figure 70. Under mean reversion strategies, there are two types: fade trades and reversal trades. Under mean departure strategies, there are also two: breakout trades and retracement trades. Mean reversion simply refers to the price going back to the mean or the average price, and we use fade trades and reversal trade strategies for this purpose. As can be seen in Figure 70, fade trades are best applied to stocks that are trading in a range, either a rectangle or a symmetrical triangle chart pattern. These are often used for trade setups on oversold conditions. The objective of fade trade is to find a point where the price stretches out too far away from the average price, with the expectation that it will go back near the average price soon. Mean reversion, reversal trades. There is also no forever as far as trends are concerned. They cannot be expected to go on without changing direction. Just like a car, a trend has to slow down before changing direction. As can be seen in Figure 70, reversal trades are best applied to stocks that are on a downtrend and are showing reversal signals like inverted head and shoulders, triple bottom, double bottom, rounding bottom chart patterns. To look for evidences, we use the moving average crossovers, price establishing a higher low base and making higher highs, breaking of downtrend lines, and bullish divergences. Mean departure simply refers to prices moving away from the average price, and we use either breakout trades and retracement trade strategies for the purpose. As can be seen from Figure 70, breakout trades are best applied to stocks that are breaking out from consolidation. The objective of a breakout trade is to find a point where there is a confirmed breakout from an established trading range or price pattern, such as a triangle or rectangle. In Facebook trading groups, this is commonly referred to as BOBO, buy-on breakouts. To look for evidences, we basically use sideways trendline break or a major resistance break together with one indicator, volume. The breakout from consolidation should be accompanied by heavy volume and with a Marubosu candlestick to show that the breakout is properly supported by buyers. Otherwise, breakouts from an established trading range with an average or less than average volume have a higher probability of being a fake out or a false break. Mean departure retracement trades. As can be seen in Figure 70, retracement trades are best applied to stocks that are on a confirmed uptrend with pullbacks in the form of bull plug or bull pennant chart patterns. This is the base of most trend following methods. The basic idea of retracement trade is to buy as price pulls back to the trend line, a support area, or a moving average, or a Fibonacci support level. Situational trading. As I previously stated, we have already established situational trading as part of the responsible trading system with the corresponding trading styles. We have already shared this idea in our post to most trading groups. After identifying opportunities and selecting the appropriate trading strategy, we use the appropriate trading style suited to the prevailing situation. This is a table showing the different trading styles. We have used walking as a baseline activity so we can easily relate to the time and energy required for each. Scalping is for short term, holding periods 2 to 4 hours, with a risk-reward ratio of 1:2. This compared to a dash. Day trading is also short term, with a holding period of hours to a day. Risk-reward ratio is from 1:2 to 1:3, and is equivalent to sprinting. Swing trading is also short term, holding period is days to weeks. Risk-reward ratio is 1:3 up to 1:4, and this is similar to jogging. Position trading is also short term. This for weeks to months. Risk-reward ratio is 1:5 up to 1:6, and this can be compared to brisk walking. An investment is long term, holding period is months to years. Risk-reward ratio is 1:7 or more, and this is equivalent to just walking. Putting it all together, we have the TRT Worksheet. The Responsible Trading System Worksheet consists of 4 parts. It is your technical analysis, your trading plan, your trading log, and your performance review all in one. Let us go over these parts one by one. Part A is for the trading rules for both buying and selling. We have the buy trigger list and sell trigger list, both for selling for profit and for cutting losses. Part B is for the trading plan, where all the data needed for decision making are indicated. This includes both the essential, fundamental, and technical data. This portion is designed to make automatic computations. You can even play with the figures. Part C is for the trading log, where notes can be written while trading. This can be observations about yourself, the stock, and about the trade. Part D is for performance review, where trades are classified and where areas for improvement are indicated. We have 2. We have the qualitative performance review and the quantitative performance review. When doing a qualitative performance review, we use subjective measures based on 4 criteria. Best trade. These are trades entered with a trading plan based on a trade setup, fully implemented, and resulted in profitable trade by not allowing greed or fear enter a trading decision. Good trade. These are trades entered with a trading plan based on a trade setup and fully implemented. Profits are taken when target price are hit, and losses are cut when stop loss are hit. Whether money is made or not is irrelevant. What is important is sticking to a trading plan because it helps develop good trading habits. Bad trade. These are trades entered with a trading plan based on the trade setup, but not fully implemented by allowing greed or fear enter a trading decision. These are trades we consider as exception to the rule. Price suddenly breaks resistance with big volume, so we decided not to take profits and disregarded the trading plan. However, price also went down as fast as it went up. Since the trade was not properly handled, this resulted in a decision to become an investor instead of a trader. Worst trade? These are trades entered without a trading plan and resulted in a loss. These are trades entered based on an impulse or a gut feel. Sometimes these are also trades entered out of boredom, not finding anything better else to do. When doing our quantitative performance review, we use the win-loss ratio. It is simply arrived at by dividing the total number of wins by the total number of trades taken for a certain period. For example, if you have taken a total of 10 trades for the month and 4 of those turned out to be winning trades, then your win ratio is 40%. 4 winning trades divided by 10 total trades for the month. Consequently, your loss ratio is 60% and your win-loss ratio is 40-60. Even with a win-loss ratio of 40-60, which is already considered a worst-case scenario, it's still enough to make us a profitable trader as long as we manage our trades very well. Assuming an average profit of 10% multiplied by 4 wins equals 40%. Again, assuming an average loss of 4% times 6 losses equals 24%. This will still result in a net gain of 16%, which is still better than the year-to-date performance of the index, which is 11% when I was preparing this presentation. I have often been asked, what is the opposite of responsible trading? Is it irresponsible trading or gambling? The answer is no. I don't think so. I always want to think in positive terms. For me, the opposite of responsible trading is misguided trading. I believe everyone wants to be a responsible trader, not only for ourselves, but for our families as well. The only problem is we do not have anyone to show us the proper way. A misguided trader became so because he didn't have access to proper knowledge and proper guidance. For the misguided trader, it is a case of circumstance, not deliberate intent. An irresponsible trader or gambler, on the other hand, has access to proper information and knowledge, but disregards them for one reason or another. Let us take a look at the signs of misguided trading. Portfolio composition. 80% or more of a misguided trader's portfolio are in speculative stocks, or basuras as we commonly call them, and he's still holding them. The original intention was to day trade when the stock was bought. However, for one reason or another, the position was not closed as intended and the trader shifted to investor mode. Revenge trading. The misguided trader incurred losses in his previous position before, and the only reason for entering the trade again is to get even. I could not help but smile when some members of Stock Market Pilipinas call themselves the Avengers, apparently to get even with a certain stock that caused them to lose substantial amount of their capital. After several months, I have never heard from them anymore. It's either they got their revenge or got wiped out, never to trade again. Emotions have no place in trading. A trade should only be entered because there is a high probability of having a high reward, Whether you win or lose, you must move on. Impulse trading. The misguided traders have a trading plan and buys the first stock that moves with the highest gain during the day. He does not know when to take profits, nor when to cut his losses. He either gets out too early, too soon, or gets out too late. Trading based on tips. The misguided trader would rather spend his time scoring the latest post in all the forums and Facebook trading groups in the hope of picking up tips instead of his own analysis and preparing a trading plan. Before I end this presentation, let me share with you a story. Once upon a time, there was an old man who lived in a tiny village and was well known for his wisdom. It seemed that he could answer any questions that was posed at him. And there was a boy who had questioned the wise man for a few times, just to trick and prove the old man can be wrong. But he hadn't been successful until one day he found another idea. He would hold a little bird in his hand and hide it behind his back. He would then ask the wise man whether the bird in his hand was dead or alive. What happens is, if the wise man says the little bird is alive, the boy will just squeeze hard to kill the bird to prove that he is wrong. On the other hand, if the wise man says it is dead, the boy will let the bird fly off, proving that the wise man is wrong. So either way, the wise man will be wrong. The boy thought that it was his time to shine. As he approached the wise man, he said, "Old man, there is a bird in my hand. Is it alive or dead?" The old man was quiet. The boy asked again, "Old man, in my hand is a bird. Is it alive or dead?" Still, the old man said nothing. The boy for the third time asked again, "Old man, in my hand is a bird. Is it alive or dead?" Then finally, the old man gave his answer with a low but firm voice. The answer to that question lays in your hands, young boy. This is an invitation to move from misguided trading to responsible trading. I invite everyone who has not yet done so to move from the darkness of misguided trading to the light of responsible trading. The book cover reflects this theme as the new trader stops being a misguided trader, he emerges to become a responsible trader, and raises his hands in victory. Just like the story shared, the answer is in your hands. It is your choice. I think you have already made the right one. Welcome to Responsible Trading. I wish you the best in your learning journey and good luck on all your trades.